Hi, this is Randy Finney with Right Side of the Chart, and today is Sunday, July 10th, 2016. I wanted to do a recap of last week's market action and, more importantly, what I see going forward. For those of you that might have missed it, I've been on vacation this week, or last week, the entire week, and I'll be returning home. We're leaving tomorrow morning. It's a 13-hour drive, so I won't be getting in. We're going to drive straight through, and I'll be getting in late Monday night. So the activity on the site will pick up back to normal Tuesday morning. I'll be back in my trading PC with all my monitors and be able to really follow the market a lot better than I can trading here remotely out of the cabin. So, all right, let's dive into the charts. As I mentioned before I even left in last week, the 4th of July is abbreviated trading week, low volume week. A lot of people are out during vacation that week. So typically I don't trade that week. The markets are prone to whipsaw signals, and that brings me up to my last update on the site on was it Thursday evening. I posted that the markets had closed at those downtrend lines I was watching, and we did have a pretty nice up day on Friday that took us just above those trend lines. However, that those breakouts were on average volume, and from my experience, breakouts that occur on anything less than 1.5 times or 150% above the average volume, those are much more likely to fail. So I don't really, bottom line, I don't read too much into that. And those downtrend lines, I've been highlighting those for a while. They're not the most solid downtrend lines, but there are enough reactions to keep an eye on it. I guess what I'm trying to say here is if we see follow through next week, if the markets continue to rally and don't look back and maybe volume picks up, there's a decent chance that breakout may stick. However, I won't be chasing it, and I'll tell you why in this video here. All right, this is the Wilshire 5000. I just wanted to go through a couple of the major indices, tell you what I see, and why I'm not at this point as strong as the market has been over the last couple of weeks. I just don't think it's worth chasing any long side breakouts here at this point. The back up for a second before I get into the outlook going forward. Keep in mind this market has gone absolutely nowhere now for over a year. We're still off the highs. In fact, I did some rough numbers, and the S&P 500, which I'm sure they'll be cheering all over CNBC if it breaks. I mean, we closed within basis points of the highs, so that one is about challenging new highs. However, the stock market, which is just a compilation of all the stocks out there that trade, is still well off the highs. The Nasdaq Composite's still down over 5% off its highs from over a year ago. The Russell 2000 is still down over 9% off its highs. The Wilshire 5000, which is more representative of the market as is the S&P 500, which are only the 500 largest companies, that's still down 2%. So yes, within shouting distance on the Wilshire 5000, that's what we're looking at here. But again, here's what I want to point out. Some breakouts to new highs are bullish, and on face value, they're all bullish. And the reason being, when you with technical analysis, the way it works is when a stock or an index breaks out to new highs, everybody that holds a position at that time is there's nobody underwater. Everybody's positive at that point. It only makes sense. If the stock is at new highs, you can't have anybody underwater at that point. So new highs are typically bullish. Now, what I like to see in taking a breakout to new highs, I like to see consolidation, a base to blast off out of. Of course, I like to see above average volume, and that all may occur here. It is possible, but just keep in mind that if and when the S&P 500 breaks out to new highs, the rest of the market, a lot more stocks than those 500 mega cap stocks are still well below their highs, and many of which have already been like the small caps and some other sectors or subsectors of the market that is are still have already experienced bear markets, corrections of 10% or more, and still well below the highs. Now, most importantly, the reason I wouldn't chase a breakout on the S&P, for example, to new highs, and I'll go through all the markets here. Here's the Wilshire. It's these divergences. Now, my trading style is relatively simple, but what I believe to be effective. And I look at these divergences, and we'll just go through this. I've talked on these many times. back here we have long-standing negative divergence. Now this was actually a series of divergent highs. If you follow the mouse down here, or let's just look at let's follow the vertical line up. So at this point, in that peak right there, so going up here, this marked our first divergent high, and we had a correction, pretty healthy correction. And what happened? The markets went on, pushed up to form another divergent high. And this is what I call double negative divergence. We had a divergent high. It did play out for definitely a tradable correction, what I call tradable, meaning you could swing trade that, be short whatever positions for more than just a few minutes or a few hours. It's a few days to a couple weeks. At this point, we put in a second divergent high with both the MACD and the RSI making lower highs. And once again, we had a correction. And at this point here, we continue to make lower highs on the MACD and the RSI while we made higher highs in prices. So this is just really one large divergence with smaller divergences within. And that led to the biggest correction that we had in years at that point. So that those divergences did play out. What happened here, as pointed out at the time, we went in, we formed a divergent low. There's positive divergence or bullish divergence. You can see here on the MACD and the RSI. That led to a very nice tradable rally. We had a correction, given there were no divergences pointing that out, but it did play out for a correction. And one could look at it this way: this was a very powerful, long-standing divergence, and so this was the move from the highs down to here was really the scope of the move that followed that divergent high, that long-standing divergence. And each bottom, each tradable rally within that bigger correction was marked with bullish divergence on the daily time frame, which I like to see for when positioning for longer-term trends where we can swing or trend trade. Now, what do we have here? As pointed out recently, we had a divergent high at this point. You can see the RSI making about equal highs, maybe slightly lower highs on the MACD above. At that point, where you follow again the vertical line up, and we had a pretty healthy correction. What happened? We went on, as mentioned, pushed up, formed a second divergent high. We had an even more powerful correction. This was all around the time of the Brexit. So now we've recouped the Brexit sell-off, we'll call it. However, as the markets, there's so many lines here. Let's try to move this one, and I'll show you. Essentially, any more upside, and I have to tell you, at this point, I almost expect it next week. I almost expect to see an early pop. If we really zoom in, maybe we did. We technically took out that previous reaction high, so we've already now formed a third consecutive divergent high. Look here, I'm just extending the MACD. It is pointed up, and as most of you know, I like to see that MACD make a bearish crossover. In other words, I want to see that blue line, the MACD line, cross back down below the white line, signal line, and confirm that divergence. Because right now, prices are moving up, and so is the MACD. So there is the potential for this divergence to be burned out. We can take out this previous reaction high here. As long as we don't take out this reaction high, I'll just show you here. Extend that out. We'd have to come above that point on the MACD to completely take out this larger divergence. And again, I'm relating what's going on right now to what happened back here. So we have, again, pretty healthy, well-defined downtrend line. Both the MACD and the RSI are still making lower highs. They're failing to keep up with prices. This is the Wilshire. We'll go ahead and take a quick look at the S&P 500. Stick with the large cap indices right now. There it is. As you can see, each one of these where I'm holding my crosshairs or follow the vertical line up, that was a divergent high. If you just look at up top at price, you'll see the corrections that followed. There was a second divergent high correction. These divergences persisted. Now you might say, well, in given, if you're like swing trading and you were short, it was very frustrating because the market was inching higher, although it wasn't going much higher. And if you were long, it was just as frustrating because at this point, because you weren't going high enough to book any profits. In other words, from this point to this point, the market was essentially flat for months into that trading period, all the way back from, March through when the market peaked. Well, the market peaked right here back in May. It had a lower high. It started rolling over here at this point. So if that's the case, I'll have to look closely. That might have been the high right there. Either way, you can see the long-standing divergence. Here we had, on a larger scale, a divergent low on the RSI down here, but not so on the MACD. That's why I put a yellow line. It was almost a bullish divergent, a bullish low, a divergent low, excuse me, right there. However, we did have on the smaller scale, and this was pointed out just as it was, I believe, a minute ago on the Wilshire. You have this price is making a lower low right here. This is your bullish divergence there as well, and that sparked that rally. And again, here we are on the S&P 500. We have one. Now I have it drawn here as two consecutive. So it was really three. We had a point right there. That was our second divergent high correction. Now that high that we made on Friday was a divergent high. And again, I don't take breakouts. That's just me, folks. Somebody asked recently on the site, I'm having a hard time. There's a lot of information, and where do I, I'm having a hard time profiting lately in the market. Where do I profit from? Well, first of all, I'll say that I am too. This bulls may cheer this move up, just as bears cheered that move down. But if you look at where prices are, this market has gone nowhere really all year. Here's where we started the year back in January. So the market's gone nowhere. We've had definitely some tradable rips and dips, both bulls and bears alike, but nobody can declare victory. In fact, if I didn't mention it starting out in this video, I wanted to say that my trend indicators on all time frames, short-term, intermediate, even my long-term trend indicators, I have never seen in years so many whipsaw signals. So right now, I'm not even talking about my trend indicators because they're I don't want to say useless. They're indeterminable. We're flip-flopping. There's bullish and bearish signals all over the place, different indices, different trend indicators. So I'm focusing right now on price action. I'm looking at these divergences. And you can see here, look at the MACD just kind of flattening around on that zero line. Prices trading in this choppy, hard to trade range. So I want to just say this. Trading, this is frustrating. Very, very difficult to navigate. And anybody that's navigated the ups and downs successfully over the past few months, more power to you. I'm just pointing out again what I see in the charts. I poured over the charts last night for hours and today. And again, I don't see a whole lot out there other than the fact that any new highs will be a divergent high. And yes, those divergences may burn through. As I just mentioned earlier, if the MACD and the RSI move higher, take out those previous highs. This market breaks out the new highs. Again, you'll see the S&P 500 be the first to do it most likely because it's almost there. But you have all those other major diversified indices that have to follow suit. So my expectation is any new highs in the S&P 500 will most likely fail. And now the question I get put to me a lot, and I've had a couple fielded recently, do I short? I'm already short. Do I add short exposure here? I don't think so. Not yet. This market has just been tough. The signals have been whippy on both the long and short side recently. What I want to see is some type of confirmation that we're not going to break out to new highs and continue on. That would be number one, bearish crossover in the MACD, having it point back down with that divergence still intact. Some type of bearish reversal candlestick, maybe a 2-3 day topping pattern, maybe a big bearish engulfing candlestick. There's many forms. I want to see impulsive selling to the downside. There's a lot of things that can indicate that top is in. So rather than try to say, well, there's divergences, divergences are only an indication of a possible trend change coming. And they can, as I say, be burned through or negated with the indicators moving higher. So we don't have confirmed divergence yet, nor do we have any type of reversal looking at price. But that's what I'll be looking for next week. So a lot of the point I'm trying to make in this video is all the trading action over this last week will just have to be continued next week. We'll have to see what happens. Just to follow up, here's the NDX, the Nasdaq, the leading index, or at least what was the leading index throughout the bull market up into the highs in 2015. And there's that long-standing divergence. Again, that was a series of divergences, as this has been so far. One potentially glass half full thing. I know I'm painting a bearish picture here, or potentially bearish picture. We did have, at least only on the MACD, about an equal low. Prices making a lower low. So you could look at this. That is divergence, positive divergence on the daily time frame, although it was not confirmed in the RSI. I like to see both, but you can see the history of these divergent tops, divergent bottoms, each and every one, without fail, has played out for a correction. Um, Somebody asked me the other day on the site, Randy, when you have divergences, how do you know when the move has played out to to where it was expected to go? In other words, when we have a divergent high, how do we know? Well, we had a correction up to this point. Should I cover all my shorts? Typically, the scope of the divergence, the magnitude of that divergence, the following move, whether it's bullish or bearish, is commensurate with it. Not now. We had a big move here, and that was only, at least time-wise, it wasn't very big divergence. But if you look how steep it was, steep, the much lower low in prices with the higher high and the MACD and the RSI, that played out for a pretty good move. But there was an example I used on to answer that question. Let me find that for you. Okay, this was the example, and I posted this in the trading room, the reply to that question. Ideally, when you have a divergent high and it coincides with a chart pattern, now those are my favorite type of setups. Bullish and bearish falling wedges being one of those. It could be any type of pattern, megaphone pattern, head and shoulders pattern. But the bullish and bearish falling wedges are simple because you can read the different various textbooks. You'll have different measurement tools, but one of the most simple and I believe the most effective way to get the expected move of a falling wedge pattern or a rising wedge pattern is to take what I've done here, the distance of the highest point of the wedge. So I measure from the top of the wedge to the bottom at the widest point of the wedge, and you add that. And all I did is created a parallel line. You right click on TC2000, create parallel line. You do it, you get another one, which I did here. And you add that to the point of the breakout. And if you see my first, I'm sorry, this was the most recent trade. And this was a failed trade. It didn't have a divergent high. We had this smaller wedge. And I had two targets here. Both this trade got stopped out recently for a very small loss. But before that, we did have, or KMB had a breakdown. And you can see it perfectly from where that broke down to the bottom there. So that's just an educational tidbit, and that gives you an idea. Again, so you look at the scope of the divergence as well, and more importantly, if you have a chart pattern that you can use the measured projection, you can go online and find out the projections. But I can tell you again, wedges, you might see different formulas, and this is one that I came across years, and I've played with them all, and it's very simple and effective. So it gives you an idea at that point. Hey, that was, again, hindsight. This wasn't the trade back here, but you can see that was it was a support level at the time right there. You had some reactions. Okay, and to start to wrap this video up here, one other thing to look at, as most of you are aware, I like to use the weekly and daily time frames to really look. Always keep an eye on those. Look at the bigger picture, formulate where things might be headed, and then to really hone down entries and exits. A minute ago, I talked on some of the things I'd like to see happen on the daily time frame to add or initiate new short exposure. Well, when you can then look down, zoom down to a 60-minute time frame. You could get shorter, but when you get too short, you don't want to. Maybe a 5-minute might be too quick, or a 15-minute chart. So the 60-minute charts are what I use for also swing tradable entries on longs or shorts. And what I mean by that, if you have a pattern here, for example, we had a bearish rising wedge pattern confirmed with negative divergence. When I see divergence, confirmed divergence, especially breakdown, that is your signal for what I call a trend trade or a swing trade that can last for days or weeks at least. And that's what happened here with the S&P 500 back in June. You can see the breakdown in the move that followed. Now, what do we have here? Again, this aligns with what I'm seeing on the daily chart. We have the divergence, the potential divergence, as I said, on the daily chart. We also have potential negative divergence here. Now, to keep this divergence intact, we'll have to see very little upside on the S&P 500 next week. It can pop up on Monday, but it'll have to fall back down pretty quickly. Otherwise, the the MACD here on the 60-minute chart will probably go on and make a new high and take that potential divergence out. However, if we do have either we gap down Monday or just maybe open flat, go down, or open, maybe we gap up, doesn't matter as long as this divergence stays intact, and then we get that bearish crossover on the MACD. The RSI, like I said, does have divergence in place. Not a lot of room for upside. You can see where the previous reaction high was, but this is potential negative divergence on the SPY. There's also this steep rising wedge pattern, and that's another thing to look at in trading too. The steeper the pattern on a rising wedge, for example, usually the sharper the move is out of that pattern once we break down. So my expectation is, and this would be an early indication of a sell signal, a move down, a break below this uptrend line. I would give this uptrend line on a scale 1 to 5. I'd only give it maybe a 3 at best, because there's only a couple reactions. I did have to clip off this candlestick here, as you had to back here as well. And that trend line captured more of the move. So this would be your first sign there. Fall back below. This was a support level I had put up last week. I'm not putting too much into that right now. But breakdown, confirmation on the divergence. We also have that divergence in place on the Nasdaq 100. If I go to the NDX, you can see the steep bearish rising wedge. This trend line is pretty well defined. 3 nice reactions. Potential divergence on the MACD. So let's give it a little room, but if it goes up much more than that, then that just tells me hold off. Don't add any short exposure. If you're long, go ahead and stay long at that point. Because we really don't have any sell signals if this is taken out. But again, we'll have to see how the markets react next week. Whatever happened this week, this last week, with the low volume and all that, it just doesn't mean much to me. And but there is a potential if we have some follow through next week, especially if some volume starts to come into the move. Either way, volume to the downside, undo that big move we had on Friday. That'd be quite bearish. All right, I was going to touch on the longer term charts, but I think I'll keep this video cap it where we're at now. The longer term charts, really nothing has changed in those. I've talked on those many times over. We have long-term bull market uptrend lines, which are all broken. Prices are all trading well below the highs, or below the highs, depending on the index. Some are well below, like I mentioned, the small caps, the Nasdaq composite, and all that. So let's see what happens next week. And again, I'll be back on Tuesday morning. I'll be traveling all day tomorrow. I will check my messages tonight before I leave. But other than that, I'll be on the road tomorrow and follow up with anybody, any questions on Tuesday. This has been Randy Finney with Right Side of the Chart. Hope you enjoy.